In this step-by-step crypto leverage trading tutorial, we'll go through what leverage trading is, how it works, the fees you'll be paying, the risks and advantages of using leverage trading in the form of crypto futures, order types, and a sample trade as well. If you're new around here, my name is James with Money's EG, and I make helpful crypto content in the form of coin updates, how-to guides, and trading tutorials just like this. So if you're new, consider subscribing. Check out the timestamps for this video in the description box, and I'll put a lot of other helpful info and resources in there as well, so be sure to have a look. Let's get into the tutorial then, and first I want to choose a platform to go and trade our futures, and we have to choose one that has fairly low fees and also good liquidity and trust overall. Bybit is one that is used by many people. You can trade a good bunch of cryptocurrencies, as you can see here, and they are pretty popular. There's no KYC needed for Bybit, so if you don't want to put your ID documents on file, then you might want to go for Bybit. The main issue for this one is that they do restrict users in the USA and the UK, maybe a couple of other countries as well, which is a problem. I know some people use a VPN to basically get around this so that they can put their location with the VPN from somewhere else. That's a choice that you may want to make, to use a VPN and then go that route. The other option though is Binance futures, and I'm sure you know Binance. It's a huge cryptocurrency exchange, the biggest in the world. It does require KYC information though, so you're going to have to sign up with your ID documents. I'm going to use Binance for this tutorial. You can see you can trade futures, stablecoin futures, leverage tokens, and options with Binance. It is a more trusted name overall, but you do need KYC. If you haven't got a trading account with Binance yet, I'll put that link at the top of the description. You can sign up within 5 minutes and essentially follow along with this tutorial. And you can get access to everything without having cash on account, so you can definitely trade and see if Binance Futures is for you. But let's get into what futures actually are in terms of cryptocurrencies and why you would trade them. So I've just gone on to Investopedia here, and this gives a good overview of what futures actually are. You can see that futures are a derivative financial contract. Now, a derivative is a product that derives its value from something else. So in the terms of cryptocurrencies, let's take a Bitcoin future. The price of the Bitcoin future is a derivative of Bitcoin itself. So when the price of Bitcoin moves, the derivative or the future will also move in relation to the Bitcoin price move. Now, futures are called as such because they actually are a contract between two people that agrees a date and a price in the future of an asset now. So when two people enter into a futures contract, you can see that the buyer must purchase or the seller must sell the underlying asset at a set price, regardless of the current market price at the expiration date. So usually what happens with the future is that you and I can agree to exchange something in 1 year's time at a price that we both agree on today. Now, the reason people trade futures usually is for commodities. So let's say you're an airline and you know that next year you are going to need jet fuel for your airplanes. You need to secure your supply, and you also need to know the price now because you need to make future predictions about your pricing strategy for seats. That is why futures exist. You can agree a price now for something in the future, which creates certainty for business models. In terms of cryptocurrency trading, when we're trading futures, it's a little bit different. Essentially, it just allows us to bet on the price of Bitcoin without actually holding Bitcoin itself. So why would we actually use leverage and futures when it comes to trading Bitcoin? Well, there are various advantages to actually trading a future rather than the underlying asset. So you can see here, you can actually go long and short a future, which you can't do with the underlying asset. So for example, with Bitcoin, it is a digital asset and you need to purchase it and hold it and keep it. That's known as going long. But when you go long and you buy Bitcoin, you can only benefit when the price rises, and when the price falls, you're actually losing money. Well, with a future of Bitcoin, you are only trading the value of Bitcoin and not Bitcoin itself. You can see that the Bitcoin futures, as on Binance right now, has a price that is exactly the same as Bitcoin itself. But when we trade these futures, we are not buying Bitcoin. We're simply trading the value and the price of Bitcoin. And so you can actually go long and short. You can go long the Bitcoin future and so benefit when the price moves up. But because it's a derivative product and not the actual asset, you can also short Bitcoin, meaning you can bet that the price is going to fall. And if it does fall, you can close out that trade and make money. So you can make money if the price goes up and if the price goes down. Next benefit is leverage, and that's the title of this video. With a future, you can actually get leverage on your trades. This will amplify your gains and your losses. On Binance, you can get up to 125 times leverage, which is absolutely insane, and I would never ever recommend that you do that. So if you had $1,000 on account, you could actually trade up to $125,000 of value in Bitcoin. Now, this is absolutely ridiculous, but that is something that you can do depending on how much you actually have on account. But just to show you how leverage works, you can see this small calculation here. So let's say you put $1,000 into Bitcoin in the spot market. So you actually invested $1,000 in Bitcoin and it went up 2%. 2% of $1,000 is $20. So for $1,000 investment, a 2% gain, you would make $20 on your investment. Now, if you were trading futures and you used leverage on your account, let's say 10 times leverage. So you put $1,000 on your account and you said to Binance, I want 10 times leverage on my $1,000, which would obviously be $10,000. The very same 2% gain in the market would realize you a $200 profit instead of $20. You have the same $1,000 investment, but that leverage that Binance has given you on top of your $1,000 essentially enables you to make 10 times the profit. It does work in exactly the opposite way when you make losses. A 2% loss on a $1,000 investment is minus $20. But if you were using 10 times leverage and you got a 2% loss, then you would actually lose $200. You can see then that both profits and losses are exaggerated, but there is a very high degree of risk because the same 2% move that would lose you maybe $20 actually would lose you $200 if it went down. When trading on leverage and using futures, you can think of your $1,000 investment as collateral and a security deposit. You are giving that over to Binance and saying, hey, look, here's $1,000. And if I actually lose on my trades, I've got $1,000 to pay for losses, but I want you to give me extra money for me to trade with so I can hopefully make extra money. Rather than with a specific investment of $1,000 in Bitcoin that is actually invested, you get that value of the underlying asset and you own that asset. But you can see you don't own the underlying when you trade futures. You simply exchange the value and the price difference from when you start the future until the future expires or you come out of the contract. Another way to use futures though is hedging your portfolio. So let's say you are invested in Bitcoin. Let's say you have $10,000 in Bitcoin and you want to hold that for the next 10 years or 20 years. That's your investment portfolio and you really see no reason to trade that. You just want to keep that in a hardware wallet and really forget about it. Well, of course, there are trading opportunities with Bitcoin and it moves all of the time. Instead of trading your actual Bitcoin, you can keep that as an asset and use it as collateral to then trade futures and try and trade around your portfolio and hedge your portfolio. So if you think that a bear market will come about in Bitcoin, maybe a little while after the Bitcoin halving, and you think the price is going to drop, you don't really want to sell your Bitcoin. You can hedge your portfolio, bet on price drops, and then try and trade around your portfolio whilst having your Bitcoin in your wallet. And then the next reason to use a future is simply to gamble. And this one can't be really underestimated. A lot of people like and enjoy gambling and they just want to use a future to do so because you can bet on the price going up and the price going down. And you don't have to actually hold Bitcoin. So a lot of people do gamble and gambling is not investing. But if that's what you want to do, then obviously you can do that. So let's get into the trading screen and I'll show you exactly what all of these numbers and figures and everything flashing actually means and how it's different to a spot trading account. Firstly though, I just want to give a risk warning for trading on leverage and trading futures. I think you really have to understand how incredibly risky it is to trade on leverage. The difference between a future and an investment is that if you invested $1,000 into Bitcoin, you can be quite confident that Bitcoin will probably not go to zero in the future. It will probably be worth something. There is of course a chance that it will go to zero, but if you put $1,000 in, it probably won't go to zero. But if you put $1,000 into leverage, you could potentially lose your whole $1,000 within 5 minutes. You would lose 100% of your investment. And so you can see the difference in risk between trading on leverage, essentially just using money as collateral, as insurance for trading losses, versus an investment in an asset. Leverage trading is unequivocally the riskiest thing you can do when you're trading. So please keep that in mind and only trade with what you genuinely can put in the bin. and really understand the risks and be comfortable with loss if you do want to trade on futures and leverage. But with that said though, let's get into what this trading screen is and the differences between this and some spot markets. So there's a big difference initially up here, and you can see BTC versus USD. This is what I'm going to be trading in this tutorial. So this is a Bitcoin US dollar market. USDT is of course a stable coin, but we have this word under here, perpetual. So this is actually a slightly different type of futures contract. Usually a futures contract will have an expiration date someday in the future. So if you and I actually enter into a contract, we may have 6 months or 1 year in the future to actually exchange on the contract and the future that we agreed upon today. A perpetual though never expires. This enables traders to essentially trade the market in Bitcoin without actually having to receive Bitcoin in the future. Traders here do not want to receive Bitcoin in the future. They just want to perpetually bet on the price. And so this is a perpetual future, meaning it doesn't expire. There's no expiry date. And so you're not going to be receiving Bitcoin in the future. Next, we have the type of margin that you can use. So we'll click on this and you can either use cross or isolated. You can read what the difference is down here, but essentially cross margin mode takes your entire account. So let's say you had $10,000 on account. It would take your entire account and actually use that as collateral against many of the trades that you go into. You can actually go into isolated margin mode, which will actually use it on a trade by trade basis. So depending on your actual trade and how much of the margin that you have on account, if that takes up a certain percentage, then that trade will be liquidated. So I would always suggest to go with cross. Let's say you have $10,000 and your portfolio is in half, you're making a 50% loss, then you'll have $5,000 of margin still left on account to fuel all of your different trades. It's easier to think of it like that as a portfolio instead of trade by trade, but you can definitely change this if you want. I'm going to leave it on cross. And then we have the amount of margin that you want to trade with. And this is on 20x. So 20x, but it can go all the way up to 125x. Like it says here, your leverage is too high. I would never recommend anyone using this much leverage. I would say at an absolute max to use maybe 5 times leverage, maybe 10 times if you really know what you're doing. But I would say for most people, even using 2 times or even just not using any leverage at all to get the hang of trading this. But certainly 5x, 10x is a huge amount of leverage for most people to trade with. So let's just put it on 5x and click continue for now. Then we have some pricing data for the future itself. So this is actually tracking the price of Bitcoin right here. Then we just have some price data so we can see the actual future itself when that funding will actually roll over, and then the 24-hour change and some other changes for the day and the volume traded. We have a normal price chart down here and the order book here that we can see volume and the candlestick chart. Now, if you want a more in-depth tutorial about charting, I do have a specific video on that will go through the basics of charts. So you can definitely look at that one. But I want to get onto order types now. And one of the benefits of trading futures and not owning the underlying is that you can sell short. So you can actually see this option here, and this is an order option that you can have. So you can buy and go long, or you can sell and go short if you want. Buying long is betting on a price rise, and selling short is betting on a price fall. We can then come over to this trade box right here, and you can see buy and sell. So this isn't actually selling anything. You don't need to own Bitcoin or any future to enter into a short trade. You can bet either way as long as you have margin on account. With futures though, there are a few different things we can do. Let's firstly just go to a market order, and let's say the size here. This is the size of your trade, so you can put 0.005 like this for Bitcoin. You can actually see down here the amount of margin that you will need to actually enter into this trade. So you can see the cost is $58, and this will change all the time depending on the price of Bitcoin. So what you actually do is use a lot size. When you trade futures, it's usually called a lot size. It's just called size here. So you can choose the size of the bet that you're placing. You can also move this up and down with a slider bar and put the amount of Bitcoin that you're willing to trade for this order. Let's say we'll just change it to 0.05, and that's really it. You can then enter into a long or a short depending on the way that you think the price will go. And you need to keep this amount of leverage in your account to enter into that trade. So if it's going to cost you $60, you need obviously a little bit more on that, because the thing is, if the price does move against you and you only have $100 in your account, then when this cost is above $100, you're gonna get stopped out of your trade. Binance will stop you out of your trade because you have no collateral left to fund the bet. That's really how futures work. Now, if you just want to enter a market order, then you can enter at the current price and you can go through and that order will be placed for you, either you're long or you're short. Using a limit order is definitely more professional though, and you can enter a lot of different actions here. So firstly, you can actually enter the price that you want to trade. So it's currently trading at 57,794. So let's put 57,650 like this. If you're going long, you want to get some at a little bit of a cheaper price. You can see we're under the market price right now, so our trade wouldn't go through, but you can enter the amount that you want to start the trade at and then enter the amount of Bitcoin right here, and it will tell you exactly how much you need on account to fund the bet. Now, if I change this to 0.05, you can see obviously one decimal place we've moved up. The amount of margin that we would require on account has gone up 10x, of course. So 576 you'd need on account to fund this bet. If the price falls down to a level where you would need $1,000, then obviously you'd be stopped out if you had $1,000 on account, because your margin has essentially reached its limit and now you're in a loss-making position. Binance would stop you out because they don't want to take any risk on essentially you not paying for your losses because you don't have any money on account with them. Let's say this is fine for me. So I have this price and this much Bitcoin. Now you see this TP and SL. If we click on this, you can see you can set a take profit or a stop loss before opening a position. This is what day traders will use when they enter into trades. So a take profit, assuming we're a buyer, is a price level above the current price that you want to sell at. Let's say you want to enter into a trade at 57,650 and you want to make a few percent. So let's say we want to put in a level of 58,250. So that would be a couple of percent or just over 1% on the current price. So we enter at 57,650 and we want to tell the system if the price gets up to 58,250, you can sell and essentially lock in my profits there. Stop loss is of course an insurance on losses. So you definitely want to do this if you're trading on leverage, because you only have a certain amount of margin and collateral on account that you are willing to use. And when you're trading on leverage, obviously the size of your trade is very large. You could be trading $10,000 with only $1,000 in your account. When trading futures, it's absolutely essential to have these stop losses in place to mitigate your risk. So let's say I put the stop loss as 57,250 like this. Now you can see what we're doing is essentially bracketing our trade. We have the mid price right here, and that's what we buy at. Now we're saying to the system, if the price goes up, sell me out at this level, which is above. If the price goes down, cut my losses, use some of my margin, but not all of it, and cut me out at this stop loss price. This is essentially a bracket, so we know before we even enter the trade what our potential profit and loss is on this trade. I would say that when you are using futures, it's imperative to use a stop loss because these things can move very quickly. And when you're trading on leverage, you can suddenly find that a 0.5% or 1% move in the price wipes out your entire $1,000 collateral. You can also see this down here, GTC. I would put GTC always, so that's good till cancelled. So the order will stay in the system for you if it can't be executed right now, which obviously below the current market price, it wouldn't be. I'll just put it on there, GTC. And then what happens when you enter in that trade is it will come down here into your open orders. This will be an open orders trade because we can't execute at this price. It's too cheap right now. So it will be coming down and working in your open orders. Now, if you have any positions open, they will be in your positions right here. And what will happen is you can see the entry price, the mark price. Mark price is the current price. And then the liquidation price, really important. So if you're in a loss-making position, you'll see the liquidation price. And if it gets down there, you might just want to cut your losses early. You can also see the margin ratio, again, very important. You can see any profit and loss you currently have on the position as well, and all the information that you would need to make some investment decisions on your open positions. When you do have open positions as well, you'll see the margin ratio here. Again, very important, and it will give you this speedometer thing here. And obviously, if you are reaching, let's say you have $1,000 and your margin is being taken up, you're making a loss up to about 800 or 900, it's going to tell you, hey, you don't have much margin left, and you either need to put more margin on account or you need to come out of some trades. Now, if you want to use futures and margin trading to go long and short cryptocurrencies, I do have some other day trading tutorials that will take you step by step through some strategies that you can use to actually trade on a daily basis and take advantage of short-term, low price movements with futures to actually try and make profit day trading. I'll link them in the description if you need some step-by-step guides on day trading. If you want to use Binance futures, I'll leave the link in the description. You can click that to go and sign up within a few minutes. Make sure to like the video if it was helpful for you. Subscribe for way more helpful cryptocurrency content, and I'll see you in the next one.